let me walk through the steps leading to foreclosure. So
Yep.
as we just touched on, obviously missing payments. Borrower is going to miss a payment or multiple payments, and then the foreclosure process can be triggered.
So
Yeah, we actually seen that. I've seen it many times. So say you've got, say, I don't know, it's November 1st, but you're not getting paid that week until November 4th on a Friday, right?
Mhm.
And you proactively reach out a week or two before the pre-authorized debit is input for that lender and say, I'm going to miss this payment. Can you please wait and I will pay you the full amount on the 4th? Chances are the lender will be like, well, at least if it's a private or more flexible lender, they can be like, yeah, absolutely. And thanks for the heads up on this, right? It's just, again, it comes back to that communication piece.
nobody wants issues on their book.
Absolutely.
Thanks for tuning in to the Canadian Private Lenders Podcast, the show about starting a private lender in Canada, the mortgage industry, and the real estate industry. Your hosts are Neal Andrino and Ryan and Neal. Enjoy.
All right, everybody, welcome back. It's episode 52 of the Canadian Private Lenders Podcast with your hosts, Ryan and Neal. Neal, how you making out today, buddy?
Not too bad. I been away on a couple trips and got a little sick, but we're back.
Same.
Yeah, I think it was COVID. I think COVID.
Yeah, it probably was.
I think
Who
everyone
cares
got
these
it.
days, though?
Everyone was just like,
Honestly,
everyone
what's the
knows,
difference?
I know. It's 100%. So anyways, no, things are great.
Good. It's our 1-year anniversary of the show, episode 52. How about that?
Wow. That's also weird is because I was searching through text messages for something yesterday and I typed in, do you want to grab a coffee? Because I was trying to remember. I know I texted this guy, but I didn't save his contact. And our conversation popped up from October of 2 years ago.
Whoa.
When I texted you, said, do you want to grab a coffee? I have some questions you about
wow.
private lending.
Yeah.
And then you're like, yeah, sure, no problem.
Okay.
And then literally the next text was like, let's chat about this.
Okay. Wow. That's crazy. 2 years ago.
Yeah.
Yeah, because I remember it was around Halloween that we had we had a lunch at down in Amano, and the rest is history, right? So
that was anyways.
Cool. That's really exciting. Yeah. So this is awesome. So, thanks for everybody who supported us through our first year. We're just getting started here and going to continue to ramp up in year 2. But today we're going to talk about something we haven't really focused on this a lot, but a very important piece with mortgage lending in general, but especially so on the private lending side is how does a property end up in foreclosure? Mm-hmm. So, obviously there's several reasons, some more prominent than others, and there's some different processes depending on location in Canada. But did you want to talk about anything else before we kick this off, Neal?
I do, because it's top of mind for me right now. And I'm just pulling up this article. That's why I'm looking at my phone. I'm sure some of you guys saw this. It's been trending all over the place. I don't know if it's stories.com that posted it or they took it from somewhere else. I'm trying to see. But anyways, it's an article from October 7th, 2024. I'm reading it off stories.com. The headline is, average 2-bedroom rent could hit $5,600 a month in Toronto.
Whoa.
By 2032, which I know that is, now I think about it, I'm like, well, that is out there.
Like
That's
8 years, yeah.
But they have, for 2027, they have $4,100 a month.
What is it now?
It is $3,000.
$3,000. Wow.
I don't understand how we get there. Like, this is I didn't read through the whole thing, but to me that just seems outlandish on how that's gonna, like, their whole logic is that the amount of completions is reducing simply because cost of construction and rates on and on and on. This seems insane to me. Even 26% in the next couple of years. I appreciate that the completions aren't happening. Mm-hmm. But like, my thing always goes back to people just can't afford it.
Yeah.
That means incomes have to be.
I was just going to say, so how are incomes going to increase by 75% in the next 7 or 8 years to keep up?
That's what,
because they're not.
The other thing is we're already at a point where our rent to income ratio is in like the 40% range.
Mm-hmm.
And historically it averages around 30. And 30 is considered not necessarily healthy, but it kind of has become for Canada's economy, the health number. So we're already over that mark. And if you watch like over history, it's like every time it's broken over 30%, it slowly creeps back to that. How are we just going to go from over that to just...
And so is the thesis of this article that there's just not going to be enough inventory and that's going to be the reason it's going up so high?
Yeah.
Because I don't know, I kind of am more optimistic now with the new regulation changes in Canada that you're actually going to see some of these detached and attached units being spurred in the market in urban centers across the country. That's going to increase the inventory of rental units, right?
Well, and the weird thing to me is this article is on the heels of the fact that we are facing a reduction in rents across the country. Like this summer, rents were reduced in all
Yeah.
major markets.
Yeah.
And it's a combination of more supply, to your point,
Mm-hmm.
and a rollback on the immigration things, right? Like they've slowed down the students.
Sure.
I also think the sentiment is changing. Like I don't know that people are as, like I talked to rentals.ca and they were like, we're getting less and less searches from India for people to be moving here. It's actually like 80% reduced from where it was
Wow.
during COVID. So I think less and less people are making that move. I've also seen a few articles in the news now where there's accusations getting thrown around between the RCMP and the federal government towards Indian consulates. I don't think that bodes well when it comes to immigration. So anyways,
Yeah.
I don't know if this article's just
I don't
firing
buy
up, but their whole concept is, they expect more immigrants and less dwellings.
Yeah, I don't buy it, but we'll see.
Anyways, 5,600 a month. We'll see. You never
We'll
know.
check in 8 years from now.
Yeah.
All right, Neal, let's talk about properties in foreclosure. So do you want to
deals.
kick it off here? Let's go through quickly kind of, we're not going to go through province by province, but we got a couple major provinces here and how it differs by each geographic area.
I like how Nova Scotia's made the major markets list now.
Oh, yeah. We're home, buddy.
We have Nova
We
Scotia,
get first on the list. No matter.
Ontario, and BC.
Yes.
So we have the foreclosures versus power of sale. So many of you have heard, if you're here in Nova Scotia, you've heard the term foreclosure. So it requires a court process. If you've checked out my other podcast, I've gone through the whole process because I bought one and I explained the whole story there. In Ontario, it's called power of sale. So this is a faster process, less court involvement. Things have slowed down a little bit on this since COVID. They think transitioned to maybe some more remote systems, and I feel like everything just in the whole world got backlogged somehow.
Totally. From all court legal systems. And yeah, I know just in speaking with our Ontario lawyers, we don't do a ton of business up there, but I know that this has become just as slow as the process is in Nova Scotia in the last 4 or 5 years.
Yeah. And I think you see this transition from foreclosure to power of sale once there's been a liquidity problem event, because what happens is, again, a foreclosure process requires the courts, requires judge and multiple lawyers, and it's a very cumbersome process. And if there ever happens where there's high numbers of foreclosures, they realize that process is inefficient and unable to handle the volume. And so they typically will go to a point where lenders can do a power of sale type process. In BC, they also operate, though, as a foreclosure system. And it also still involves the courts there. I don't know if that's maybe BC's just, I don't know, BC's maybe a little more, I don't want to say it, but liberal, but I think that might be
I think so.
Part of the process.
Yeah, I'm not. I don't have personal experience with that, but it'd be great to get a lender on from BC to go through that a little bit more detail. But so what triggers this type of event? So the default process typically happens when a borrower defaults on the mortgage. Pretty self-explanatory, right? Usually through missed payments. I'd say most lenders would start this process after a couple missed payments or non-responsiveness from the client as a result of a missed payment. Or another default act that could be, no insurance, or, like we were talking about before we started recording, bulldozing your house when it's, when you have a CMHC insured mortgage on it, right? Yeah. So that would also be an active default. So, but it's typically through the missed payments.
To that point, I will say, typically they don't want to foreclose. They'd much rather just get their money back.
Oh, yeah.
And so they're going to try and work with you to find a way to get an exit.
Yep.
Before they foreclose. That's their last
resort.
Yeah.
And I think, and we'll go through this as well, but I think, a lot of it comes back to the communication between the lender and the borrower, right? And if the borrower is in communication with the lender and saying, this is the reason why I missed this payment, and here's my plan to fix it, chances are, especially private lenders, being through this experience many times, you want to work with that borrower to find a solution that works for everybody, and most importantly for the lender to get their money paid back so you can continue paying your investors, right? It's more so when the borrower goes dark and doesn't respond for weeks and months at a time that you're going to go down a dark road.
So I tell every one of my clients that gets in hot water, I'm like, have you talked to the bank? I'm like, no. Yeah. And I'm like, how many months has it been? 2. I'm like, oh no, you need to reach out.
Trouble.
Like, but I'm trying to do this and this and this. I'm like, tell them that. At least tell them you're trying to get out of here, because otherwise you're going to get a letter and they're going to take your property. And it's all going to be a huge situation. Anyways.
Yeah. Let me walk through the steps leading to foreclosure. So as we just touched on, obviously missing payments. Borrower is going to miss a payment or multiple payments and then the foreclosure process can be triggered. And as a result of that, they're going to face NSF fees. If payments bounce due to non-sufficient funds, you're going to have additional fees applied as well, which can also escalate the financial strain that the borrower is facing, right? So additional incentive to avoid that. Typically what would happen from a lender perspective is that you would go through, you could send a demand letter on your own, or you could have your lawyer send a demand letter after that first missed payment or multiple missed payments. And that basically is a formal letter requesting immediate repayment of the full amount due, right? And that's kind of like strike one. Like, here you go. You've seen this. Here's a legal demand saying you need to pay us back this amount, or additional foreclosure process will be beginning. And like we touched on previously, the non-responsiveness of borrowers can really cause this to accelerate, right? Versus a borrower who comes in and works out a repayment plan that can potentially avoid legal action.
Yep, 100%. It's like not paying your credit card and then trying to keep up with the rate. It's impossible.
Exactly.
Yeah. So how to exit from this situation? Again, start the communication early. Explain. If you know it's coming too, I honestly tell them, I'm like, if you know you're going to miss this, if you call them and talk to them, explain that you're coming out with an exit.
Yep.
Maybe they'll hold the payment, because it's better than just creating this whole stack of fees. If you're like, look, I have a firm contract on my property, I'm selling it, whatever it may be.
Yeah.
So
yeah, we actually seen that. I've seen it many times. So say you've got say, I don't know, it's November 1st, but you're not getting paid that week until November 4th on a Friday, right? And you proactively reach out a week or two before the pre-authorized debit is input for that lender and say, I'm going to miss this payment. Can you please wait, and I will pay you the full amount on the 4th? Chances are the lender will be like, well, at least if it's a private or more flexible lender, they can be like, yeah, absolutely. And thanks for the heads up on this, right? It's just, again, it comes back to that communication piece.
Nobody wants issues on their book.
Absolutely.
But anyways, to go back to the exit, as I mentioned, the first and probably, maybe not the best, but I think probably the best, because if you're having that problem, it's good to get the debt off your book.
Yep.
And hopefully free up some equity, is selling the property.
Yep.
If the property has good collateral, strong value, you can, well, we're talking from a lender's perspective, encourage your borrowers to sell before you get to that foreclosure position, which can save them and you from having to go through a court-ordered sale. So again, I think selling is probably your number one option. The next thing is, like we've been talking about multiple times, is flexibility. As a borrower, if your borrower is reaching out to you and being upfront, your best option would be to work with them. As you don't want to be rigid on the fact that, okay, no, it comes out on the first. You don't want to get in a position where you're putting them in default or you're adding additional stress onto the situation. Ultimately, it's your best interest to get the money back, right? Yep. So look at potentially restructuring it, but at the same time, I think being smart and then also being like, okay, if this is happening this month, typically it doesn't just all fix itself the next month.
Yep.
You're usually going to be getting into a situation. So then it's like, okay, we'll do this month. How are we going to prevent this moving forward, and how are we going to get out of this? And then we have on here, consider partial payments. Again, not an ideal situation, but if you're private and you're smaller and you're getting started, it's definitely worthwhile to do this, and just to keep the money flowing, keep the deal alive.
Exactly.
Until you can get out of it. Partial payments are better than no payments.
Exactly. Having that plan in place, and as long as you're able to hit those milestones that both parties have agreed to, will lead to much better solutions.
Yeah,
right?
Exactly.
I've been in the private lending game for a while, and let me tell you, Mortgage Automator is the ultimate software for private lenders. It's been a total game changer for our business. I've scaled 2 private lending companies, and I couldn't have done it without this software. The Mortgage Automator team truly understands the challenges we face, and they're constantly thinking ahead. For example, they've developed new anti-money laundering and know your client tools to keep you compliant with the latest FinTrack regulations, and their platform is SOC 2 compliant, ensuring your financial data is secure. This software eliminates almost every admin burden you can think of in the private mortgage business, saving us thousands on staffing costs. No more manually typing term sheets or tracking files in Excel. So whether you're a new private lender looking for an efficient solution or an established lender aiming to scale up, Mortgage Automator is the solution for you. See if Mortgage Automator could be a good fit for your unique lending needs at www.mortgageautomator.com/switch. So for rental properties, there's another option here that lenders will have an assignment of rents clause in any term sheet. And so with a rental property, the lenders can enact the assignment of rents clause, where rental income basically goes directly to the lender once enforced upon. That'll help cover the mortgage payment and protect the lender's position. So this is one that I've had to use a few times in the past, and it's really nice to have. You still need the the legal system to sign off on this. But
Mhm.
say you've got like a large, say you get like a $2 million loan, multiple units of rental income coming in, and the borrower's just not paying you, right? So if you're able to get that assignment of rent clause activated,
Mhm.
you're covering most, if not all, of your monthly payments as a result of that.
Yep. No, 100%. This one is very common. I feel like, again, if you've done anything, whether you've been a borrower or a lender, you see this everywhere.
Absolutely.
For construction and rental loans, you want to make sure that you're doing your due diligence on them. You want to make sure when you're underwriting to really ensure that the value is there, whether you're starting on the land or on a partial structure that's existing. Really, again, because if you consider the fact that if you have to foreclose on a construction project and it's a gutted house that was appraised at 600 when it was a finished home, it might not be worth the 600 now, and you don't want to be in that position where you go upside down. So it's extremely important when you're getting involved in construction loans, keeping in mind that, again, you need to do a ton of due diligence beforehand and even during the process of letting the draws go. Part of this, and again, if you've borrowed the money from anyone, I'd say from A lenders, any of them, they do what's called holdbacks. This is extremely important for a bunch of reasons. They, as a lender, you're protecting your position and ensuring that the project is progressing satisfactorily, but you're also like, you never know because contractors might not get paid and they could lien, right? I think it's up to 60 days after they've left the site. And I think that's really an important part where you want to see that they've paid their contractors because you might get in a position where you're not the only debt holder on there anymore. If someone takes the money from you, doesn't pay their contractor, now there's an additional debt holder on the property. If they don't pay that contractor, they end up losing in court against them. They could then push to also foreclose on the property to get paid out. Even though you might be in first position, they're going to get on you. I don't know how that exact process works. You might be able to comment on that. But even if you're not in first, you can push and request to get it to that point. And then if you know your borrower's not using the money efficiently, like you're not going to feel great about being a part of that either.
Yep. No, you said it well.
Yeah. And then also, again, I've mentioned a few times, but complexity and defaults. So a partially completed project, whether it's even if it's brand new and it's framed up, you don't want to be overextended on that based on a land value and concrete and wood. And the guys that are going to come buy that from you, they're not going to be paying full freight. They're going to be looking for an extreme deal, even though it might be worth it completely. There's a very small pool of buyers who are willing to step into a project that's half completed without maybe the paperwork that's required. Like it's a very tough position to be in if you're taking on something that's not completed. And to that point, there's actually a really neat house being built. I think it's in Lawrencetown, and the price, they just keep dropping it and dropping it and dropping it. And I'm like, you could not buy the land and get it to that weather tight position for what it's up for.
Yeah.
But nobody wants to step in where it sits.
It's crazy. Yeah. Because you have to take on that additional burden of finishing it, right? So it's funny to think about that a 40% done property is not worth 40% of the value, right? So
No.
And that'll come up in one of our next point here. But I'll just go back and comment on the holdbacks quickly there. Just locally here in Atlantic Canada, Nova Scotia and Newfoundland have 10% holdbacks on any construction draw. Okay. So the lawyer would actually hold those funds. And similarly in New Brunswick and PEI, it's 15%. So a significant portion is held back in trust,
15
right?
is a lot.
Yeah, it is. And we often see borrowers who, get to a point, usually that's held for a minimum of 60 days.
Yep.
They get to the point where they're knocking on the door on day 59 and 60 and say, can I get my hold back now because I need it, right? And for the most part, some lenders would actually say, we're not releasing any holdbacks until the entire project is done plus 60 days. We've had more flexibility on that in the past. If it's a great borrower, someone maybe we've dealt with before, their AAA credit, and they say, I'd like to get this holdback released, and, they've had 2-3 draws already, and, they're 80% complete, but they're 60 days beyond that, and they want to release their 10%, 15%. We've made that exception at times.
When I had a bunch of projects on the go, and I had multiple different lenders, and they all have their different policies and how they do it. So I remember sometimes I just get an email from my lawyer being like, hey, they're willing to let go of the holdback if you want it. We have 100 grand sitting here. And that was the best, like, unexpected bonus.
Totally.
Because I would just be like, well, I'm not going to get that until I'm done. And then they started stacking up. Or again, there's some that would just be like 60 days. Like, yeah, we'll drop it off to you.
Yeah. Is that me?
I think you probably did a couple, and a few of the other credit unions had done a few. But then some of them, to your point, it wouldn't be till I'm completely finished, which also was a bonus because then when you get your refi or you sell it on your adjustment sheet, you're like, oh, yeah, there's a holdback for whatever,
exactly.
120K. That's a bonus that I'm going to get now.
100%. it keeps you honest too, right?
Yeah.
Because you need to have that amount of float there for overages or whatever else unexpectedly comes up.
Yeah.
And it's another buffer for the lender to protect them.
Yeah.
Let's talk about default rates and security through paper or term sheets.
Yeah.
So there's often lenders will enact a default rate, and this will be, a good lender will have this outlined in their commitment or term sheet, which says, if there's any active default, this rate is now going to apply. And that could be anything from, if your current rate's at 10, 12%, a default rate could be 17%. I've seen it as high as like 28% in some places, right?
Mm-hmm.
So it's a significant change, right? If your payments are going to double or triple as a result of this. And that's another lever to protect the lender in the case where, they're getting non-responsiveness from a borrower who's missed 2 to 3 payments in a row. And then they say, okay, well, while we wait through the foreclosure process here, that's going to take us months, you're now paying 25% instead of 11% because that's what it said on our term sheet. And that's what we're able to do. And of course, it's essential from a lender perspective to outline this, regardless whether you think you have, the best borrower in the world, you've done 10 deals for them before, or it's a new borrower who's had a shaky credit history. You're going to want to outline on your term sheet that they sign off on before you advance any funds that these default rates are going to apply if A, B, or C is to happen during that loan.
In my head, as a borrower, I remember the first time I saw this, I was like, "Oh, these greedy bastards." I guess now, as being more involved in the lender side, I understand two things. It's obviously to in try and encourage the borrower to not get into this position.
Yeah.
Secondly, the additional cost, stress, and risk of going into that default position, I actually can understand now why that rate gets charged, because there is a ton of expenses that get incurred during that process, not only just for that single deal, but the impact that it has on the rest of the business.
Yep.
I'm now more understanding of it. I think when people are getting to that 28% rate, they might be getting a little gougy.
Yeah.
But I do think that there should be a reason to be able to increase the rate at that point, because
it's a scare tactic, right? At the end of the day. And believe me, lenders don't want to enact this.
That's the thing.
They don't want to.
That's exactly. It's more of a scare tactic, and ultimately the money will get spent on cleanup to get this thing sorted out, and even the damage of their business, of
management companies, legal fees, all those things, and
reputation too.
Reputation. Yep, absolutely.
Like every single person that's been involved in this or had interest the first question they ask is, how many things are in default?
Yeah. And this is also important for our next point that you're going to go through here from a loan to value perspective, because you could charge all these fees and all these default fees, but if there's not enough equity in the property, you're shit out of luck.
Yeah.
Take us through, Neil.
Anyways, that's another thing I was thinking about. Some of these ones that do 95% LTV, I'm like, you have no space. So LTV considerations, it's really important to maintain a lower loan to value to give you that cushion in the event of default. Similar to what we've been talking about, it stacks up very quickly. So if you're missing payments, plus the rate's gone up, plus there's fees, and potentially the property value might not necessarily be what you originally even considered, that even if you're at 65% loan to value, that 35% can get sucked up very quickly. And so working at a high loan to value can put you at an extreme risk, especially if the property value drops. That's the other consideration, is if you start seeing property values drop, and you then have to include realtor fees, lawyer fees. Like if property values drop 10%, plus you take off 5% for realtors, another 5% in general, lawyer fees, and then if there's an additional 5% in missed payments, which would only be a few months, that by the time you go through the whole process, that would be reasonable. That's 25%. So if you're at 75% LTV, you're now hopefully just covering all your expenses.
Yep, absolutely.
At 75% LTV.
Yeah. And think about this too. So, back, close to 10 years ago when I started in the industry, property values in New Brunswick they're still low relative now, but back then they were probably half of what they are now, right? So say you're on a property that's worth $150,000 and it was in a rural area and you only went 50% LTV on it. Okay. Say it was an 80K loan. Your 50% LTV, you're talking $30,000 to $40,000 in legal costs.
Jeez.
You're talking, whatever cabinets got ripped out or floors got ripped out of the place as the borrowers left. And then if you're in a small town, everybody knows that house was foreclosed upon, right? So let's say it only sells for $125,000. You're underwater already significantly. You're taking a $15K loss on that property at a 50% loan to value in quotations there, because you took too much risk in a given area on a tough borrower.
If you're an investor from outside of Atlantic Canada, don't worry, we're managing this. And the prices have come up a fair bit now, so we don't hopefully get in these positions nearly as much.
We've learned from doing this in the past. We just don't do these types of loans anymore, right? That's why we have a minimum property value that we would consider. Has to be the right geographic area, has to be the right borrower profile to avoid this type of thing where your loan to value ratio doesn't matter too much when your total equity in the property is only $50,000.
This is where blankets, if there's an opportunity, are really nice because you can stack up equity and different markets potentially, like within neighborhoods or types of properties, and you can hopefully reduce your risk exposure.
Absolutely. And we're going to touch on that in the next episode as well. But let's just wrap up on this one, Neal. So let's say, as a lender, you have to go through the whole default, foreclosure, power of sale process, whatever it might be. It's very important to go through a post-default deal review to figure out what went wrong and how it can be avoided in the future, right? So lenders should really conduct a detailed review of the original underwriting of the file to see if there was any warning signs or gaps in the due diligence. You can go through and say, okay, this is the reason why. Why did we make the exception on X, or why did we do Y? Why did we lend in this location that we typically don't lend in, right? Learning from these defaults will help improve future underwriting practices, leading to stronger, more secure deals and less headaches for you and your business.
This is just good business practice. I'm going to put that out there. I wouldn't say as a lender you should look at yourself as equally at fault, but to some extent, you should honestly reflect on it like that because you are a part of that deal, and that's the only way you're going to get better at this. So it's extremely important that you don't just look at them like, oh, these borrowers were shit or whatever. It's like, no, I also allowed them to get there. And I was a part of that. How did I not see this coming?
Absolutely. Nothing more important in this business than protecting investor capital. And you're right. It is the lender's responsibility, regardless of what happened at the end of the day, to avoid it happening in the future.
Yeah, 100%.
Thank you to our sponsor, Mortgage Automator. And thanks, everybody, for listening.
Thanks, guys. Hey, guys. It's Neal Andrino, your co-host and your co-founder at Keystone Capital and Director of Investor Relations. I'm also a real estate agent, real estate investor, and business owner.
And your co-host here, Ryan and Neal. I'm the co-founder and president of Keystone Capital Group. Keystone Capital Group is licensed under the Mortgage Regulations Act of Nova Scotia, license number 3000549, and through FCMB, license number 88799. And keep in mind, the views of this podcast are for informational purposes only and is not financial advice.